In goodwill accounting procedures, the new partner brings the goodwill in the form of cash and to be retained in the business. This is one type. The new partner brings the goodwill in the form of cash into the partnership firm and is to be retained in the business. This is one type. For this, capital account data, for this, cash is brought into our firm. So cash account data to new partner's capital account to goodwill account. So new partner brings the capital and goodwill in the form of cash. Entry is cash account data to new partner capital account, goodwill account. This is one. This is goodwill is brought in the form of cash. It is to be retained in the firm. For that one, we have to make an entry that goodwill account data to all partners capital accounts. All partners capital accounts. So goodwill is in the firm because that goodwill is distributed among the partners and is retained in the business. Is it clear? So new partner brings the goodwill in the form of cash and along with the capital. So entry is cash account data to new partner capital account to goodwill account, and this goodwill is distributed among the partners. Goodwill account data to all partners accounts. This is retained in the business, and sometimes that goodwill which is brought by the new partner can be withdrawn based on the agreement, based on the consensus among the partners, as well new and as well as old, that can be withdrawn. In such situations, nearly three entries come into the picture. One is, first entry is cash account data to new partner's capital account to goodwill account. First entry. Yes, now goodwill is brought in the form of cash. The next entry is goodwill is distributed among the partners. So goodwill account data to all partners capital accounts. Goodwill account data to all partners capital account. Okay. Now distributed among the partners, the goodwill is in the firm. But if it is withdrawn, what happens? Cash goes out. Cash goes out. Cash goes because cash is withdrawn by the partners. The entry is cash. The entry is all partners capital account data to cash account. Listen carefully. All partners capital account data to we shall see a problem on admission of a partner in partnership accounts. Now I read the problem. Please listen, observe it. Suresh and Ramesh are partners in a business sharing profits and losses in the ratio of 1:1. These partners sharing the profits equally, profits and losses equally. So 1:1, that means equally. Balance sheet as on 31st March 2013 is as follows. This balance is concerned to Suresh and Ramesh, which is as on 31st March 2013, and the partners share the profit and losses in the ratio of 1:1. It means they share equally. Yes, we shall see. Liabilities, assets. If we see at liabilities side, first capital accounts. Suresh 50,000, Ramesh 24,000, total 74,000. Creditors 57,000. Bills payable 20,000. Reserve funds 9,000. Okay, four aspects are come: capital, creditors, bills payable, reserve fund. Yes. And if we see at assets side, building 30,000, machinery 10,000, furniture 9,500, debtors 40,000, less RDD, reserve for doubtful debts, that is provision for doubtful debts. RDD is 1,000. So outside 39,000. Stock 30,000. Bills receivable 7,600. Cash at bank 33,900. Okay, so here building, asset side building, machinery, furniture, and debtors, there is reserve. Stock, bills receivable, cash at bank. Yes, now shall go further. They admitted Kailash on 1st April 2013 as a partner on the following grounds, on the following terms, on the following provisions. Kailash will bring rupees 30,000 as his capital for 1 by 4th share in future profits. This is capital. And rupees 12,000 as goodwill, which will be withdrawn by all partners. Second, stock and machinery to be depreciated by 10%. Two aspects. Third, RDD, reserve for doubtful debts, is to be maintained at 5% on the toss. Fourth adjustment is building to be appreciated by 20% and furniture is revalued at 10,000. Building to be appreciated by 20% and furniture is revalued at 10,000. Prepare. Profit and loss account. Profit and loss adjustment account or revaluation account. Partners capital accounts and balance sheet of the new firm. Okay. Before going to solve the problem, we shall see once again the adjustments. First adjustment. Kailash bring 30,000 as his capital. The share is 1 by 4th in future profits. And 12,000 is as goodwill. So 12,000 also is brought in the form of cash. And it is not retained in the business and to be withdrawn by the whole partners. So what is the share of previous share? Already we have seen here 2:3. 2:3 is the profit sharing ratio of all partners and 12,000 is the goodwill which is brought by the new partner, that is Kailash, and is to be withdrawn by the partners. Is it clear? Yes. 12,000 is the goodwill to be withdrawn by the whole partners. Second one is stock and machinery to be depreciated. These two aspects are depreciated by 10%. Yes, RDD is to be maintained at 5%. Generally, we maintain the RDD on the toss. There is no doubt in it. to be maintained on debtors. Building to be appreciated by 20%, and furniture is revalued at 10,000. With this information, we should prepare profit and loss adjustment account, or it is also called as revaluation account, partners capital accounts, and the balance sheet of new firm. New firm means after joining the Kailash. Okay, after joining the new partner. Yes. Let us see profit and loss adjustment account. Yes, stock is depreciated. How much? Stock is depreciated by 10%. The value of the stock is 30,000. On this 30,000 rupees, we have to calculate 10% of depreciation. So 3,000. And machinery here, if we see the value of the machinery, it's only 10,000. So we have to calculate 10%, that is 1,000. See carefully. Machinery, 1,000 is depreciated. And reserve for doubtful debts should be maintained. See the adjustment regarding this. 5% on debtors. Yes. So what is debtors? See, 40,000. 5%. How much on 40,000? 5%. Calculate it. So 2,000 is the reserve for doubtful debts. Should be maintained 2%, 5%. But if we calculate on 40,000, it is 2,000. But it is already made 1,000 in the previous balance sheet. See, 1,000 is already maintained. So we have to add another 1,000. And in the final balance sheet, we have to mention 2,000. Clear? In the previous balance sheet, 1,000. Now we are showing 1,000 in the revaluation account because total 2,000. So difference amount is only shown in the revaluation account. So see the revaluation account. Yes, 1,000 is shown. But while preparing the balance sheet at the end of this problem, at the end of, after joining the new one, we have to show 2,000 as RDD. I think it is clear. Okay. Now move further. Building and furniture is appreciated by 10%. buildings 6,000 is mentioned. So in the problem it is 60,000. Sorry, buildings 30,000, but 20%. Appreciation is 20%. So see how much it. So 20%, see the building to be appreciated by 20% and furniture is valued at 10%. Valued at 10,000. So first see buildings. Okay, it is appreciated. 6,000 is appreciated. And also the furniture. Okay, furniture, see 10,000, revalued 10,000. But whereas in the starting balance sheet it is 9,500. So it is increased by 500. So it should be mentioned at the credit side. Credit side of, see here, credit side of revaluation account or profit and loss adjustment account. Yes, if we sum up at the credit side, total is 6,500 and the difference is 1,500. What is this 1,500? What is this 1,500? Is it loss or profit? Think for your some time. Is it loss or profit? It is the profit because credit side balance is higher than the debit side. But when the balance at the debit side is much, if we compare to the credit side, then it occurs loss. So in this present problem, it is the profit. So here 1,500 is the profit and should be distributed among the partners. It should be distributed among the partners. Yes. So partners share e- the profits equally. So the revaluation profit is 6,500. Suresh, so this should be distributed among the both the partners, Sure, Suresh and Ramesh, in the ratio of 1 is to 1, 1500 that is equal to 750 and 750. Yes, this is a profit regarding the revaluation. Now let us see the partners' capital accounts. Yes, in the balance sheet, starting balance sheet, the balance sheet before the Suresh and Ramesh, sorry, before the admission of the Kailash, that means the initial balance sheet, it shows that capital balances of Suresh 50,000, Ramesh 24,000. Okay. Now let us see the other aspects. Reserve fund should be distributed among the partners equally. 9,000 is distributed among the partners equally. 4,500 and 4,500. Just now we have seen that revaluation profit is 1,500, so it is distributed among the partners 750, 750. Yes. Now if we shall, okay, now we shall go to the debit side. Cash, no, this is one minute, wait, this, we shall see cash. How much? Cash is 30,000 in the form as capital amount. 30,000 is the capital of Kailash. It is entered cash. And goodwill, premium for goodwill, that is, this new partner has brought 12,000 in the form of, for goodwill in the form of cash. So goodwill account data to cash, so goodwill account data to, or goodwill is distributed among the partners 6,000, 6,000. The goodwill which is brought by the new partner is distributed among the old partners, So 6,000, 6,000 is distributed. Now we shall see this amount. What is this amount? 6,000, 6,000. What is this amount? In adjustment, it is said that, already we have seen 2 times. In the first adjustment, it is said that 12,000 is brought for goodwill in the form of cash, and also said that goodwill is to be withdrawn by the partners, is to be withdrawn by the old partners. So 6,000, 6,000, here it is withdrawn. Okay. Now goodwill withdrawn, clearly mentioned. Now we shall go further. This is the balances of capital accounts. So 55,250 29,250 and 30,000. These three figures are the balances of capital accounts of Suresh, Ramesh and Kailash. Okay. Now we have prepared the capital accounts. Is over. Now we are moving for balance sheet. Before going to balance sheet, we shall see cash account. See cash account. See balance brought down. Balance brought down is how much? Balance brought down is 33,900 is the balance. Kailash capital account 30,000. So 30,000 cash is brought by Kailash. Premium 12,000 also brought by Kailash. In these figures, Suresh and Ramesh withdrawn 6,000, 6,000. That is 12,000. This is the closing balance of cash. 63,900. This is shown in the balance sheet. See? Yes. Cash at bank 63,900. Clear? Yes. We shall move further. Now 57,000 creditors. And capitals just now we have seen. I have made the, see above we have the balances here. These are the balances 55 to 50, 29 to 50, 30,000. Suresh, Ramesh and Kailash. And bills payable 20,000. And next, building 36,000, furniture 10,000. After adjusting, after making the adjustments, these are the figures arrived. So building 36,000, furniture 10,000, bills receivable 7,600, sundry debtors 40,000. This less reserve for doubtful debts, RDD. RDD. So 1,000 was made previously and 1,000 we have shown in the revaluation account. So total is 2,000. After deducting this, 38,000 is the balancing amount. Machinery depreciation 1,000. So 9,000. Stock depreciation 3,000, 27,000. Cash at bank already just now have seen 63,900. Yes, shall move further. So shall see the new ratio of three partners. we shall see the new ratio of all partners. Suresh and Ramesh, all ratio 1:1. See carefully. 1:1. Kailash share 1/4. Let the total share of the firm is 1. The remaining share of the firm is 1 minus 1/4. Remaining share of the firm 1 minus 1/4 is equal to 3/4. Suresh new share is equal to remaining share is 3/4. So we should multiply the old share with the remaining share. So Suresh share is 3/4 into 1/2. 1/2 is the previous share ratio, previous ratio is equal to 3/8. And Ramesh new share is equal to 3/4 into 1/2. Same 8/3. And the new profit sharing ratio is equal to 3/8, 3/8, 1/4. See, 3/8, 3/8, 1/4. So that comes 3:3:2. The new ratio is 3:3:2. And sacrificing ratio. It's very easy to calculate it. If we know the old ratio and new ratio, we can easily calculate the sacrificing ratio. Sacrificing ratio is equal to old ratio minus new ratio. Suresh sacrifice 1/2 minus 3/8. 1/8. Again, Ramesh sacrifice is equal to 1/8 minus 3/8 is equal to 1/8. Sacrificing ratio is 1:1. So we have found new ratio and we have found sacrificing ratio. So new ratio is 3:3:2. Okay. Yes, we shall see in brief. Main adjustments are given. 30,000 cash is brought in the form of capital for 1/4 share in future profits and 12,000 as goodwill and withdrawn by the partners, old partners. That is natural. And stock and machinery depreciated by 10%. Audit is to be maintained 5%. Building is appreciated by 20% and furniture is revalued 10,000. So we have prepared profit and loss, appropriation adjustment account or revaluation account we have made in this these profits. They earned the 750 profits and capital accounts we have made, and we have arrived the balance and shown in the new balance sheet. In this way, we can prepare the balance sheet. With this, I conclude this class. Thank you all.